Picture this. You just got that very first paycheck. The euphoria is completely real, right? You suddenly feel like, finally, I don't have to ask anyone for cash anymore. Naturally, you immediately want to go out and buy that brand new phone you've been eyeing or, maybe start saving for a dream bike. It is a totally phenomenal feeling to start enjoying life on your own terms. But welcome to this explainer, because today we're actually going to look at the ultimate blueprint for compounding your wealth and securing true financial freedom.
Okay, let's dive into this, because we have a very real problem here. Right when you start earning and just want to enjoy spending your own cash, your parents or relatives inevitably chime in telling you need to save for when you're 60, so you aren't begging for money in retirement. But let's be real for a second. You're probably looking at an entry-level salary, right? Maybe 15,000 to 30,000 taka a month. How on earth are you supposed to save for some distant retirement on that amount? How can Amanda's salary actually guarantee a lifetime of financial freedom?
Section 1. The First Salary Trap and Smart Spending.
So, navigating this whole first salary trap is basically a massive tug-of-war between spending and smart spending. In fact, financial advisors will tell you that you actually need to think way more carefully about how you spend your money than how you earn it. We have this brilliant English proverb that perfectly grounds our practical savings lens for today. If you can't buy it twice, don't buy it. I mean, wow, does your spending have that kind of laser-focused intention? This quote really challenges us to just pause, take a breath, and critically evaluate our financial habits before every single purchase. Now, once you've actually got your spending under control, the second big question is figuring out exactly where to invest what you've saved. We all know that leaving money totally idle in a drawer is just a guaranteed way to lose its value to inflation. But you have to be super careful here. Borrowing money to invest for short-term goals, say getting married or buying a car in the next 2 or 3 years, is a massive, massive trap. You see, the stock market can literally take 3 or 4 years to show any real returns, while a bank loan demands monthly interest payments right away. So if you have short-term goals, just keep that cash safely in the bank. So for your long-term wealth, where exactly should a beginner put their money to keep it safe and growing? Well, the absolute most practical, time-saving solution out there for most people is index funds. It's basically a giant basket of top companies. You don't need any deep, complex knowledge of individual stocks. You don't have to actively manage your portfolio every day, which, trust me, saves you a ton of stress. And historically speaking, you can reasonably expect average returns of around 13%. For a beginner, this is absolutely your safest, most practical engine for growth.
Let's move to Section 2 and see how this builds. Redefining modern retirement.
To truly wrap our heads around financial freedom, we basically have to completely challenge the outdated mindset of what retirement actually means today. The old definition, stopping work entirely at age 60 and essentially just doing nothing. But the new definition, it's entirely about freedom. It's about working on your own terms whenever you want, taking breaks when you feel like it, and having absolutely zero bosses breathing down your neck. To get there, you need passive income. And remember what Robert Kiyosaki points out in his famous book, Rich Dad, Poor Dad? Retirement actually depends way less on exactly how much you earn and pretty much entirely on how much of it you actually keep.
Section 3. The Practical Savings Strategy.
All right, let's move from all this philosophy to the cold, hard numbers. Looking through a practical savings lens, we want to aim for a very realistic, concrete goal, building a retirement corpus of about 15 to 20 million taka. So how do you actually get there on an entry-level paycheck? Well, if your salary is 30,000 taka or more, your target is to save 15,000. So essentially half. Under 30,000, aim to tuck away 10,000. And if things are really tight right now, start with just 5,000. Obviously, as you earn more, you scale this up. But the absolute most important takeaway here, you just have to begin. You literally just have to start the habit today.
Section 4. The Power of 13% Returns.
Now, what's really interesting about this is seeing the math actually in action. If we project that 15,000 taka monthly savings habit over a 20-year period, letting it grow in an index fund yielding that historical 13%, the sheer scale of the result is just staggering. 17.1 million taka. I mean, no way, right? But that is the literal power of consistent compounding interest over 2 decades. Just by diligently setting aside 15,000 a month, you completely cross the threshold into a highly comfortable retirement.
But hey, it's totally natural to look at that huge 17.1 million number and feel a sudden wave of panic. You might be sitting there thinking, wait, what happens when I actually start withdrawing from this pile to live? Won't the money just eventually run out? And what about inflation? That 7 to 8% inflation is just slowly eating away at the value of everything. And you know what? That is a very, very valid fear to have.
Section 5. Mastering the 4% Rule. To completely put those fears to rest, we're going to look at the ultimate mathematical solution.
Let's walk through this step by step together, because this right here is exactly where analyzing those 13% returns through a practical savings lens truly pays off. Step 1. You take your 13% average index fund return and subtract the expected 8% inflation. That leaves you with a 5% real, tangible growth rate. Step 2. You withdraw exactly 4% of your total principal annually to cover your daily living expenses. Step 3. Because you only took out 4%, you leave that remaining 1% safely in the account. This allows your principal balance to just continue growing slowly over time. Boom! You've just created a completely inflation-adjusted perpetual withdrawal system.
Let's break that down so you know exactly where every single percentage point of your 13% return is actually going. The biggest chunk, that 8%, well, that's silently eaten by inflation, but we've already planned for that, so no sweat. Then, that 4% slice is your money to pull out and actually live on. And finally, that tiny but mighty 1%, that goes right back into the fund to keep the whole engine humming so your core balance never actually drops.
So the crucial point is connecting all these abstract percentages to cold hard cash. On a 17.1 million taka balance, your 4% annual withdrawal equates to about 684,000 taka a year. When you divide that up by 12 months, you are looking at 57,000 taka a month in pure passive income. And remember, because of the math we literally just did, this happens forever without ever shrinking your original principal.
And this brilliantly illustrates our core message for today. True financial freedom is built on undeniable math and smart daily habits, not necessarily having some massive bloated income. This entire strategy deeply reflects the core principles found in essential reading like The Psychology of Money. Ultimately, it's about how you behave with the money you have right now in your pocket, not just how much you can potentially make in the future.
Which leaves us with the absolute most important question of all. Look at the undeniable math we just went over together. Look at how incredibly achievable this all is if you just apply a practical savings lens to your everyday life. So, what is your very first step to financial freedom going to be today? Are you going to finally cut out that one unnecessary expense? Are you going to set up that 5,000 or 15,000 taka auto transfer right now? Start saving, start investing in those index funds, and let compounding do all the heavy lifting for your future. Thanks for joining me on this explainer. Now go take that first step.